Okay, so to use the most profitable trading strategy for the New York and London session, we need a couple of indicators. Head over to the indicators tab, type in looks, sessions, and this is what the indicator looks like. It will mark all the days where you can trade the Forex market. If we zoom in a little bit, we can also see the trading sessions. London marked in blue, orange is New York, Sydney, Australia is yellow, and Tokyo is red. Now, since this trading strategy is focused on the London and New York, we need to remove the Australia and Tokyo levels. So simply click on the indicator, and at the bottom just here where it says Session C, click off the Tokyo and Sydney sessions. I also don't like to have the daily divider where it says Monday, Tuesday, Wednesday. It makes no sense to me, so uncheck this if you want. And now we are left with the two relevant sessions, which is the London and New York. The second indicator is a simple trend following indicator, which is the moving average of 200. You can find it just over here where it says moving average simple, add it to your charts, and my period length is 200. This is what you need. I also styled it in green, but it's really personal choice. And last but not least, we need another indicator, which is called the intraday sell. We can find it just over here. It's by Nix 1008. Add it to your charts. The settings for the indicator is default. However, the style, we need to remove the reversal, the bar color, and the SMA line. Just to make it clear as possible, having cluttered charts never helps. Okay, so for this profitable trading strategy, we're going to be using the 5-minute time frame, and we're going to be utilizing London and New York session crossovers. What do I mean? When the candlesticks actually cross in between the blue and the orange boxes. This is where the most liquidity in the market is, right? As we can see, after it crossed, it pushed the market really heavily towards the upside. And if we are correct with our analysis, we can profit a lot of money quickly. Now, if we take a look just over here, we can see that we had a buy signal from our intraday indicator. So let's add a long position just off that candlestick, and you could argue that it did pull back towards the downside before it pushed towards the upside, potentially could be stopping you out. However, if you have your stop loss a little bit lower, maybe just somewhere over here around 17 pips, you should be pretty damn fine because you have 200 moving average protecting your trade straight away. And if it kind of crosses the 200 moving average, then maybe you can consider having a early entry. But if the market spikes, let's say it has a little spike, drops down, but the candlestick actually closes above, the 200 moving average line, you're fine. You keep the trade open, and eventually it should continue moving towards the upside, because typically at 1 p.m. over here, the market chooses its direction, whether it's going to go up or down. Within around 30 to an hour's time, the market chooses. As we can see, we had this crude scalp trade over here around 13.20, and over here at 2 p.m. you had a little bounce of the 200 moving average and continued moving towards the upside. You would be trading 1-to-1 risk to reward. Once it reaches maybe half of your trading position, you move stop loss to entry, or maybe just below the 200 moving average, just to kind of manage your risk in case it starts dropping down. But very unlikely. I tested this strategy multiple times. Trust me, it definitely works. So moving along, sometimes you're going to be in this type of situation where the crossover happens but doesn't have a signal around this area zone from the intraday indicator telling you to buy. If this happens, you simply don't want to be trading. As we can see, we had a buy signal just over here, but the London session was already over. The blue box is outside of the range. It's not a good trading position, and although in this case it would have been a profitable trade, that's not the way you trade this strategy. Now, another example, in situations like this where the crossover has recently happened, and at 13:30 we had a intraday buy signal, you could potentially buy over here and target the 200 moving average. However, we don't really have a solid area of stop loss. I mean, if we do put it just over here below the support area level, we are risking 20 pips to potentially gain around 12.5 pips. Just because the 200 moving average is over here and it could potentially bounce back and go towards the downside. However, in this case, it struggled and pushed towards the upside, but you would never know this is happening, right? In real-time charts, you are speculating, you see the 200 moving average is here. You would definitely be very cautious of this moving average and potentially be scared that it could be pulling back down. A quick example of the 200 moving average, look, buy over here. 200 moving average reacted, pushed the market further down. That is why you don't want to be trading until the market has actually crossed the moving average. Then you can, trade towards the upside. But until then, you want to be very, very careful. Okay, here's an example of a great trading opportunity Euro USD has given us. We just had the crossover from London to New York, both active sessions at the moment. And at 1340, we had buy signal just over here. Our moving average is below the candlestick, showing upwards momentum and direction. So we simply always want to target our stop loss just below the 200 moving average, because likely if the market continues moving down, it will definitely bounce off it and push the market further up. It's very likely moving averages are heavily respected in the Forex markets, so you always want to target your stop loss below it in this case to potentially save your trade if it goes a little bit more sour. However, in this case, we can continue trading further, but why? Because there is no area of sensitivity, right? We had a push towards the upside, we had an exhaustion back to the previous area of resistance, which is support over here, pushes the market up, makes a new higher level, pulls back, that's a new higher low, pushes the market further up. As we can see, with even with this candlestick, if I just zoom in on that candlestick, actually, you can see that it broke past, look, it broke past, closed above this area level, showing you a continuation of trend. What that means is you continue trading. Once you get a candlestick that is something like this, where it indicates there is a lot of sell pressure over here, you can close off your trading position and re-enter again after you retest the previous area of support. Look at this support level over here, push, exhaustion, support level, bullish engulfing candlestick. You could potentially enter for a small scalp position again to kind of continue trading that way. Or you can simply hold the trade, as I said, and close it off just over here. Once you see this candlestick price action, this straight away gives you a 2.42 risk to reward ratio, so you're risking around 30 pips, you are gaining 70 pips if you continue trading this little strategy. And trust me, it's quite easy. The indicator does everything for you. You just need to look for the right setups and stay a patient trader. If you're a beginner, this strategy will work for you if you stay patient and see what I'm talking about. Okay, now let's take a look at an example that is much more trickier, but you still can make a ton of money. So the logic is, we're currently sitting in London session. The New York has just started. This candlestick 13:05, so 5 minutes we are in the London and New York session. We get a buy signal just over here telling us to buy. But why should we not buy? Well, the 200 moving average is over here, so that is a strong area of resistance, right? And if we mark our area zones, this could be our resistance. And also there's another resistance just over here. If we just simply drag this along, you can see that every time the market touches this area zone, for some reason it goes back towards the downside. So at the moment, you're scared to trade, because what if the market doesn't break this area of resistance and just continues dropping down? You don't want to be stuck in this trading scenario. What you want to do is wait patiently. You already have your buy signal over here, right? This is a valid trade. It's telling you it's likely a buy, but you need to wait for the right price action. So as we can see, we are waiting for a breakout of maybe the 200 moving average. The 200 moving average has broken, and look at this candlestick wick telling you there's a ton of sellers over here, as we initially expected, right? Strong area of resistance, loads of sellers, push the market further down. However, we did break the 200 moving average, which is a positive sign, and the next candlestick now was a breakout. So what we want to do is wait for a push, exhaustion back to the previous area sensitivity scenario. We're going to be looking at maybe the 1 minute time frame. So this is the 5 minute. Let's see what happens. And it pulls back. Did you see that? that pullback over here where the wick touches that area of sensitivity, if we just use the 1 minute time frame, we can actually see that it touches this area zone. So push, exhaustion, use multiple time frames, so lower time frames to see what's actually happening. It touches over here. Once it does that, you can enter your trading position. So something like this, come back to the 5 minute now. Let's imagine we entered our trading position on the 1 minute, drag this out, put our stop loss just below the 200 moving average. So we have our stop loss protected by the 200, but not only that, the resistance over here previously becomes support level once it is broken. So a push exhaustion means this is a support area level, and that is why this is a favorable trading position. Since we are risking 6 pips, we can target 6 pips as well. But if it continues pushing towards the upside, as we can see, like this previous area of small resistance was broken again, we can continue trading for further pip gains and potentially 2 to 1 to 3 to 1 risk to reward. Let's see what actually happens. It pushes the market further up, and then we get 2 candlestick formations that are bearish. This is a shooting star, which tells you that there is a lot of selling pressure and likely the market is turning around. And no wonder, because after that push, there's going to be an exhaustion back to the previous area of sensitivity, which is currently happening. But in this move, you could have potentially made a ton of money simply by using multiple time frame analysis, support and resistance, and a couple of indicators. It's worth mentioning, not every day you will have this signal, but that's totally fine. Since this is the Euro US dollar, you could potentially be trading GBP US dollar, USD CAD, USD Swiss franc, and the likelihood that one of the pairs is going to have this scenario is much higher. I would only stick with the major US dollar pairs, which typically gives you a much better spread, so you can profit quicker when you're scalping the markets this way. So if you enjoyed this video, give it a like. I've been trading for 10 years. I have a signals group, ton of feedback, tons of reviews. If you want to join, link down in the description below. I also made an ebook with 300 pages where I show you exactly how I trade and learn everything in Forex. Trust me, it's so good. If you want to grab it, link in the description below. You get lifetime VIP signals with it. And if you want another strategy for a beginner, trust me, this video over here will do the trick.